that some societies in emerging markets will accrue wealth faster than the West, faster than North America, and faster than Western Europe. Those societies are societies in East and Southeast Asia, in South Asia, and in the Middle East. I spend a fair bit of time in the Middle East, as you know, and walking through the gold souk in Dubai is an absolutely invaluable sociological experiment. When you walk through there, you see all of the South Asian, Indian, Bengali, Pakistani workers who are working in the Gulf region convert their paychecks into physical gold. And you see thousands and thousands and thousands of workers doing this. So I think a very important trend in gold and silver will be as ordinary people in China and Vietnam and India, Bangladesh, Pakistan, Saudi Arabia, even Iraq in the Middle East, get more wealthy, they will store increasing amounts of their wealth, their surplus cash, in gold. These peoples have a deep affinity, cultural affinity for gold that goes back several thousand years. They also have deep experience, deeper than we do, experience with government, and they've learned as a consequence of that not to trust their own government and not to trust their own currencies. If you talk to people in Pakistan or India or Bangladesh about their national currencies, about rupees and things like that, they look at you and laugh. They just absolutely laugh. They assume that the political class in their country is there to steal their wealth. And as a consequence of that, they prefer to have physical possession of their wealth in the form of gold or silver. And I think that they're making a decision that is correct in the consequence of where I see the world going, and particularly in the consequence of the history that they've experienced. In the near term, you're right, I think the prices of gold and silver could fall. Everybody seems to be in the trade in the near term, which is problematic. I think that very low U.S. dollar interest rates and the ready availability of very, very, very short-term financial credit has meant that there is a U.S. dollar carry trade in all manner of physical commodities, as hedge funds and others could borrow overnight funds extremely cheaply at very low subsidized interest rates and bet on the decline of the dollar and the appreciation of hard assets like copper and gold. I think that we will see a decline in the availability of very cheap short-term credit in the United States, and that could negatively impact the price of gold and silver in the near term, which I would welcome because I'd like to own a lot more.
Understood. What about on the junior stock side? What do you see there?
The junior stocks are, as a category, overpriced. Remember that 95% of the juniors are ultimately worthless. So you need to be extraordinarily picky in terms of selecting your juniors. You know, at conferences that I appear at, I always deride speculators and talk about investments. And my wife occasionally raises her hand and says, "Yes, Rick, but all the money that you invest, you made speculating." So I'm not criticizing the junior space per se as a place to make money. What I am trying to say is that at times like we are in right now, where the market has performed very, very, very well for 10 or 12 months, it's extremely risky. During periods like the one that we went through 14 or 15 months ago, where people are absolutely terrified, perversely, most of the risk is out of the market because stuff is so cheap. If you are going to participate in junior markets, the very first thing that you have to understand is that you are either a contrarian or you are a victim. There is no second choice. If you get lulled into a sense of security by a rising market, what really happens is that you're training yourself to pay too much for something. If you get panicked out of a declining market, what is really happening is that you are training yourself to sell assets that you own too cheaply. We need to reverse that training so that we buy aggressively when goods are on sale and sell them fairly aggressively once they've recovered. Hence, the period that we're in, by and large, is a selling period. It's not a buying period, particularly because the masses are coming into the market as a consequence of its relative performance over the last 12 months. The second thing that we need to recognize, and I need to give you special credit for this, is that the junior business is much more a people game than an asset game. You know, when people tout junior stocks, they talk about some wonderful mining project and, you know, how the property would have made everybody a whole bunch of money 100 years ago if the mule hadn't died. It's always an asset-intensive discussion. But the fact is that men make mines, or increasingly men and women make mines. And focusing on the people associated with the juniors is absolutely critical. It is a fact that some people are more successful than others. It is a fact that the 80-20 rule, where 80% of the production is done by 20% of the population, applies to junior mining stocks. It is, in fact, a fact that that law, the 80-20 rule, conformably aligns again, which means that 20% of the 20% do 80% of the 80%. That's a hard calculation, so I'll tell you that what the math suggests is that 4% of the managements in junior company populations generate about two-thirds of the wealth generated. So the first thing you need to know in the context of the juniors is you need to either be a contrarian or you need to be a victim. The second thing that you need to know is stick with the proven performers. And I don't mean proven performers in terms of stock. I mean proven performers in terms of managements. Management teams that have found mines, put mines in production, and sold them, made money for shareholders in the past, are those people who are statistically most likely to do so in the future. Absolutely critical.
Rick, and also with regards to the junior stocks in particular, when I watch the tech boom, I refer to it as the Pac-Man phase, right? Because you would have this consolidation taking place. I've written about this, but you've got Cisco and everybody was coming in and basically in the networking sector and some of these other sectors doing 12 to 18 acquisitions a year. And that was the thing at the time, was to have the strong product cycle. But at this point now, it's about replacing reserves. It's about coming up with quality acquisitions. And it's very difficult, as you said, because most of these things are junk heaps or bad management, et cetera, or maybe not in geographically friendly locations. And you know how to put all the pieces together over there at what you do. But isn't the time upon us now, Rick? My question for you is for this acquisition of this Pac-Man phase to begin to become a reality where these mid-tiers and these majors come in and just start to really acquire the good ones. Isn't that going to become a bit of a war, as we just saw with Camplats?
You're absolutely correct. The acquisition phase needs to happen. Listen, we have 4,000 managements in the junior sector, which means that general and administrative expenditures, both in relation to the value of the total assets and in relation to exploration dollars, are much, much, much too high. We need many, many, many fewer managements. The second thing is that very few juniors can afford to have the whole requisite skill set present, the exploration skill set, the construction skill set, the development skill set, and the operational skill set. We need larger entities that are able to combine all of those things. Larger entities are more liquid and hence have lower costs of capital. So for all of these reasons, the consolidation phase that you're talking about is absolutely the wave of the future. And I think in the context of playing the juniors, one of the themes that you need to play, and certainly the theme that we have been playing in the last 18 months, has been to identify the companies that are most likely to be consolidated and put those in your portfolio because they will be consolidated. And it's healthy for everybody. Of course, the management teams and the companies that get taken over that find themselves thanked and excused and looking for something else to do don't always enjoy the process. But it's very healthy for the industry as a whole, and it's extremely healthy for speculators and investors.
And as you said, Rick, as you go through this cycle, for instance, I'm going back in time now to the tech boom, but as you were in that tech boom, it was really obviously advantageous because if Cisco was making the acquisition, or if it was Intel, or if it was whoever, they tended to dip that day, the day of the acquisition, right? Whereas the other one had a big spike on the premium takeover. So what you're saying to listeners globally is you need to be in the acquired companies. You can go out and you can buy the Gold Corps and these types of things, but really the most advantageous ones to own are the ones that are going to be acquired, correct?
Absolutely. And you point up something else very interesting. You know, I have a very, very, very large position in Gold Corp. As a consequence of having been part of selling them and their predecessor companies, I think 8 different companies in the last 20 years.
Wow.
Often the cheapest way to buy Gold Corp